When you're buying a home, your credit score, it's either going to save you or cost you thousands of dollars on your mortgage. Hey, what's going on, guys? Welcome back to the Real Estate Playbook. My name's Andrew, and today we're going to tackle the discussion of how your credit score ultimately affects your mortgage, but really more importantly, how your mortgage then affects your home purchase, right? Because your mortgage is just a vehicle to help you accomplish your dream of buying a home. So first, let's just talk about what a credit score is. And in simple terms, a credit score is just a metric used for the three credit bureaus, which are Experian, Equifax, and TransUnion, to understand how you have been with your credit, right? Have you been responsible with the credit you've had in the past? So essentially, any time that you've had a credit card, a personal loan, an auto loan, a past mortgage, those credit bureaus are going to see whether or not you've been paying things up on time and how responsible you've been with them. So essentially, your credit score is just showing credit bureaus what you have done in the past with credit and how responsible you have been. And the reason why lenders care about your credit score is because they want to know simply, are you going to pay them back, right? Because when you're getting a mortgage to buy a home, you are leveraging the bank's money to buy this asset. And the bank wants to know, hey, are you going to give them their money back, right? And depending on what your credit score is, that's going to help them decide the likelihood of you paying back your loan. So at the end of the day, they're just using this metric because they want to get paid back and they want to make sure that you are qualified to receive this money if you end up purchasing a home. And when lenders are looking at your credit score, they're really breaking down your credit score into different segments and different ranges to classify whether you have poor credit or excellent credit. And when lenders are looking at your credit score, they're going to break it up into different segments of the different ranges. And those different ranges are going to display, your likelihood and just kind of overall grade, if you will, on your ability to pay back your loan. So if you're anywhere under 580, that would be considered poor. If you're anywhere between 580 and 669, that would be considered a fair credit score. If you're anywhere between that 670 and 740, now we're getting into a good credit score. Anywhere from 740 to, just under 800, that would be pretty good. That'd be a very good credit score. And then if you can get a credit score above 800, that would be excellent. So those are different ranges that lenders look at and they kind of place you in. But really for a home buying, for a mortgage, you want to be over 740. Anytime your credit score, dips below 740, that's when you're going to see big adjustments in the different variables that affect your mortgage. And same is true opposite wise. So anytime your credit score is above at 740, that's when you start to really reap the rewards of having a good credit score. So those are different ranges, but just remember 740, you want to be above that when it comes to purchasing a home with your mortgage. So the reason why your credit score would be important to you as the consumer is because your credit score is going to give you favorable or unfavorable terms on your mortgage. And really the biggest one that people think of when it comes to your credit is your interest rate. Because if you have a lower credit score, you're going to have a higher interest rate because basically the bank is going to penalize you because you have not shown to be strong with credit in the past. So the same can be true on the other end of the spectrum, where if you have a great credit score, hopefully you will get a lower interest rate because the bank is looking at you and saying, hey, you're responsible with credit. Let's reward you with a better interest rate. So your interest rate, that is a big way that your credit score will affect your mortgage. But really another massive one is your mortgage insurance or private mortgage insurance. So if you're somebody who's putting less than 20% down on your home and you're going to resort to using private mortgage insurance, your credit score is going to affect your that payment big time. So if you have a low credit score, that's going to really jack up the price that you're paying on your private mortgage insurance. Whereas if you have a great credit score, this could be a very minimal fee that you're paying every month because you're putting less than 20% down. So if this is applicable to you, if you're someone who's putting less than a 20% down payment on your home, we definitely want to have a strong credit score because if it's not, you could really be paying big time on that mortgage insurance. Another area of your mortgage that will be affected by your credit score is what's called your loan to value. And essentially that's just the amount of money you're borrowing compared to what your home is worth, right? And essentially, if you have a lower credit score, you may not be able to borrow as much money. You may have to put a bigger down payment for the bank to even lend you money. Whereas if you have a great credit score, you may be able to put a very low down payment on your home to get in because you have a strong credit score. So that's just another area where your credit score can come into play. Lastly, another area that your credit score can affect is what's called your debt to income ratio. And that's essentially a ratio telling banks how much money you can borrow compared to the income you earn. And if you have a great credit score, the banks are going to let you borrow more money. But the opposite's true. So if you have a lower credit score, they're going to let you borrow less. So as you can see, your credit score plays a big, big role in the different components of a mortgage and the terms that you can get. So we want to always be working to increase our credit score and be monitoring that and keeping track of that, because if we let that slip, it could cost you big time. So there you have it, guys. There's a 10,000 foot brief overview of what your credit score is, why it matters to lenders, the different ranges that lenders look at, and ultimately the main components that are affected by your credit score. Thank you guys for watching. If you found value with this, please share with a friend or family who you know could also get value from this. Otherwise, please subscribe and stay tuned for more mortgage tools and tips coming out in the near future. Take care.